Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com.
Choosing the right insurance coverage for multifamily properties isn't that complicated, if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz, and we'll start the conversation.
Today on the podcast, we have Nick Stageberg. Nick is a software tech startup veteran who founded Black Swan Real Estate and now has over 300 million assets under management. Thanks for joining us, Nick. Can you start by telling the listeners a little bit more about yourself and what you do?
Yeah, that was a great little introduction there, Gary. Appreciate it. We've got a deep vertical integration piece to our company. So we have a property management company. We have a full-time maintenance, grounds people, lawn and snow, facilities, everything. We have about 47 full-time employees. So we have a private equity fund, and as you said, we have about 300 million assets under management. But we also have kind of all the nuts and bolts stuff below that. And then I'm a married father of four. My wife's my full partner in the business. So, I've got my background in tech. She's got her background in medicine. She, trained as a physician at the Mayo Clinic, and we love to just kind of apply all those things to our business in real estate investment.
Awesome. Well, you do a lot of things different than me. And that's what I love about real estate. You can make money in every market, whether the market in an upturn, a downturn, different philosophies, which I love. And I love talking to other people. And one thing you do differently is your infinite return. So why don't you explain to investors what that is and what's your kind of thesis behind it?
Yeah, so we've been doing this for about 12 years. We've never sold a property to date. We always do a cash out refi as kind of our liquidity event versus a sale. I love the notion that if you really love a property and take amazing care of it, it's ultimately going to be worth more to you than it will be to the marketplace. So we do deep value add renovations. We'll go in and put in new 3-centimeter quartz counters, and we won't just refinish existing countertops. We'll put in all new tubs and surrounds and stuff. We won't just re-enamel an old tub or old tile surround. So we do really deep value add that to a great extent is kind of worth more to us than it is to the marketplace, because 10 years from now, we won't have to go re-renovate that unit because the old renovations have worn off. I think that, Warren Buffett says that you should never buy any asset where you'd be upset or sad if the market shut down for 10 years. So just thinking with that long-term hold in mind, it really kind of primes you to make good decisions. Because I don't know about you, but all the worst decisions I've ever made tend to be short-sighted decisions. So if you're like, oh man, this is such a good deal, maybe I can flip this thing and sell it in a few years. Man, that's the buy that's going to kind of eat your lunch. And, maybe you don't lose money on it, but you lose your mind. Whereas the asset where it's like, gosh, it's in rough shape, it's kind of expensive, but it's in such a good location. This thing is going to do amazing in the long term. Like, that's the asset you want to buy. So our model is very different from a typical model. It kind of revolves around that indefinite hold period. We buy the asset, we raise capital to buy that asset. 100% of the profits go to our investors until they get a full return of capital. We have no fees whatsoever. And then we do a 50-50 split after that. So if you kind of punch all that into a calculator versus sort of the traditional real estate syndication scheme, I would say that your typical investor is going to come out ahead 5 or 10% in sort of a worst case for that limited partner. But it's a huge win for me as well, because I'm able to raise capital very effectively. I'd say it's kind of a no-brainer opportunity for our investors. We've got 20 million on the wait list for our next fund here. And I think anytime you work your hearts out to serve other people, like that's so much more motivating than serving yourself. And then once you align incentives, like if you set it up so that if the people that you serve win, you win, well, you win. And it's just so much more motivating to get out of bed in the morning and say, what can I do to put my investors first? And that's not a platitude. That's not something we say. That's reflected in, how we buy assets, how we renovate assets, and ultimately how we structure our private equity fund.
Well, I love it how you are structured to align with investors' goals. There's certainly a lot of operators out there that are, have super high fees. They get their money from and on the front. They're not investing in their own deals. So that's a huge win for your investors to have that alignment. I love how you said, you're a typical owner, not a typical, but a lot of owners will just do the, hey, if something's broken, just stick a Band-Aid over it. But you're investing in your properties for the future, and yeah, like you said, making sure that they're going to stand up for the longer. You're going to go the extra mile, which is really cool.
Another thing that sets us apart is that 5% of all of our profits go to charity. We built a school last year, found an abandoned 40,000 square foot office building, and did an adaptive reuse, got teachers and parents together, ripping up carpet and rolling paint and running a carpet shampooer for what little carpet was left. And we've got hundreds of kids going to that school now today. It's kind of the coolest thing I feel like I've ever done in my life. And then 5% of our profits go to our staff in a profit share as well. So again, just ways that we can give back. One of my mentors, Tony Robbins, he teaches that you will work 10 times harder to serve other people than you will to serve yourself. So if you can just find something you're really passionate about serving, you're gonna find a way to serve more people in a bigger way and become a bigger person. And I found that to be completely true.
Very cool. Very cool. Where's that school that you founded?
It's the Rochester Arts and Sciences Academy here in Rochester, Minnesota. It's kind of our headquarters. So it's couple miles from here. That's where my kiddos go to school every morning. I'll tell you, it's hard to have a bad day when the first thing you do is drop your kids off at the school that you helped build. It was a really cool opportunity. There's a million other people who get all the credit for that. I guess I was just the crazy guy that wanted to build a school, and it all just kind of came to be. That's
very cool. Yeah, every day you drop your kids off, you get to see something that you created. So vertical integration, when did you decide you wanted to be vertically integrated?
I don't know if there was ever a specific point in time, but I think, had a similar experience to most property owners, which is that it can be really challenging to find good property management where you feel like you get the outcomes that you should get. And again, just like how we structure our private equity fund different, I think that really comes back to the way most property management agreements are structured. The way a typical property management agreement is structured, it is literally impossible for the property management company to lose money. Even if the asset's losing money, the property management company cannot lose money. And there's not a sufficient alignment of incentives. So as the owner, you really care about like the net operating income of the building, and the property management company, they really care about maximizing their profit as a property management company, which usually comes about as a small fee of the gross income of the property. Well, if you work really hard and create massive value and have incredible customer service, and you drive an extra $25 or $50 per unit per month, that can create incredible shifts in your NOI, but it has a trivial impact on the ultimate, fee, profit that property management company collects. So there's zero incentive, or almost zero incentive, for them to really push rents, and then all expenses pass through. So you have zero incentive to lower your cell phone bill or reduce your administrative costs for postage or whatever whatever those little expenses are that add up to quite a bit of money. So it's not an arrangement that made any sense to me from the get-go. So when we started getting a big enough portfolio that it was really kind of a burden to manage, because we started out buying and self-managing properties, we looked at handing those properties over to a third-party property manager, and it just wasn't good. And we said, okay, if we try to do this ourselves, we'll kind of collapse under our own weight before we can really scale the company, because you really need hundreds of units before you can get that economy of scale to have management and maintenance and everything. So what we said was, we're going to start a third-party property management company that kind of solves the problems that we're experiencing to race to that break-even point in terms of economies of scale. And that's exactly what we did. So we represented a ton of other investors, helped them purchase properties, manage those properties to collect fee income to be able to make payroll and everything. These days, we don't really do new third-party clients because we've gotten that economy of scale. We mostly just manage our own stuff. Our legacy clients, we still keep them. They're beautiful relationships, but really all along, we just wanted to manage our own stuff. And there's been no limit to the benefits that we've discovered. And it's always really difficult at first, like way harder than I expected it to be. Great example of that is we brought lawn service in-house this year. So we went out and bought, $250,000 of tractors and trailers and trucks and all, everything you need to run a proper, lawn services company, because we're going to spend, many hundreds of thousands of dollars on, lawn and landscaping this year across our assets. And then it's been a really dry summer in Minnesota, in our area, which is very unusual for our area. So our assets, we've only had to mow the lawn a handful of times, way less than we normally would have to. So if I rewind the clock and look back, year to date, year over year, we have reduced our lawn care cost 90% year over year by bringing that in-house. I find you typically cut costs about 50% with any of these things that you bring in-house. But then in addition to that, there's this alignment of incentive, because if the grass doesn't need to be mowed because there hasn't been any rain, I'm not sending my guys out to go mow the lawn. But if I have a vendor, they're sending their guys out to mow the lawn that doesn't need to be mowed because they've got to make payroll. I have other things my guys can do. They can go renovate a unit or solve some maintenance tickets. They don't need to go out and uselessly mow the lawn. So you end up with, you're not just cutting your costs in half. You're often reducing your costs even more than that, but it's even more than that, because I tell my guys, when you're out there on the riding mower, like, you are doing a 360-degree inspection of the property. And while you're at it, if you could cut the grass, that would be great. So it's a totally different mindset than like a third party, lawn provider. So everyone has a smartphone, and there's a chat channel where they can report concerns that they see. So they took a cell phone, they saw a little a hole where a dog had dug a hole in a backyard, and said, "Hey, I think we've got an issue here." That within seconds escalated to the property management team. They said, "Yep, we had a recent move-in in that unit, and it looks like they have a puppy or something that they didn't disclose." Very common property management issue. We need to do a 24-hour inspection on that unit. Lo and behold, there's a dog in that unit. There's damage that's happening inside the unit, because of course there is if there's damage happening outside the unit. And we're able to resolve that situation before it, results in a $10,000 plus, property turnover expense. So that's the real savings of vertical integration. Anytime you bring things in-house, you don't just save costs, you don't just improve quality, you get control and communication. So that's how we're able to do, I would say things that are simply not possible when you aren't vertically integrated. And it's tough. It would be easier to manage a staff of 4 than a staff of 40, but there's just superpowers that you have when you have that vertical integration piece.
Absolutely. Going back to infinite returns, I know there is a time when you do eventually sell. So what determines that time?
Yeah. So I guess it's my guess that at some point Blackstone or someone else will come along and make us an offer we can't refuse. I keep going on podcasts and saying, we've got $3 billion assets under management, or, whatever the number is that day. And eventually someone will probably make that offer. We're never, soliciting for an offer. Brokers call every day saying, "Hey, would you like to sell?" And nope, that's just not what we're interested in. But at some point we probably will receive an offer we can't refuse. We'd be negligent to accept that offer. I have no idea when that will be. Maybe it's next year, maybe it's 40 years from now. I sometimes wonder, if we sold, like, what would I do then? I'd probably just want to go buy more real estate. So unless we really wanted to relocate to another market, or we saw a big shift coming that is not on our radar right now, I mean, we're just not, unless we got kind of a crazy number for our whole portfolio, I just don't see us being in a hurry to sell. That calculus could change. We're all humans and our life changes. Maybe I pass away or something, and my wife says, I don't want to go on without my husband or something. And we've had arrangements in place. We have a trust with a board of directors in place to handle all those sorts of things. But every time we get frustrated with an asset, we say, "Gosh, well, maybe we should just sell it." And then we kind of run the numbers on it, and we're like, "Gosh, got to pay the capital gains, you got to recapture the depreciation, and we've already kind of gone through the hard part, renovating it and getting our tenants in place and everything. And the boiler broke down, and now there's this $10,000 bill, but we're kind of past the hard part. Let's go ahead and keep it." And I'd say once every 6 months or so, we go through that math on one of our assets, and it just the math never makes sense to sell an asset.
Nice. I know you're in Rochester. You do a lot of investments, and also in Tacoma, I believe, correct?
That's right. Yeah, it's kind of our second market there.
Nice. So what do you foresee in those markets in the next 16 to 18 months?
Yeah, so Rochester's kind of a secret market, and it's very insular. It's very difficult to like break into the market if you're not a local. People don't even answer the phone if you have an out of town area code. It's just kind of the culture of the place. That's the way the regulatory climate works. The way the government works is they don't like out of state landlords, so to speak. You actually have to reside in one of the in this county or one of the 6 surrounding counties in order to be a property manager here. So it's a very kind of insular market in that way. But when you're here, it can be a very lucrative market. It's the home of the Mayo Clinic. It's the home of the Destination Medical Center Initiative, so which is the largest public-private per capita public infrastructure spend in the entire country. It's like Dubai here. Technically, the MSA is only 250,000 people, but a few weeks ago, Mayo just announced a $4 billion expansion to their campus here in Rochester. They've got campuses everywhere, but this is the mothership. This is like their main campus. So we own, probably 6 apartment buildings that are within a 1-block radius of where that $4 billion campus is coming in. And we didn't pay $4 billion for our buildings. We paid, $10 million or whatever. So anytime you have a $4 billion neighbor going in next door to your $10 million apartment building, I think you're going to be in good shape. And that's just, it's a really neat market. There's, foreign royalty, and the president stops by from time to time. And it's a small town that has kind of the cap rates and just advantages of a smaller community that kind of punches above its weight and acts like a larger community, high growth community. I was born here. I moved away and then happened to meet a woman who happened to become a doctor, who happened to match to the Mayo Clinic for her residency. And like the one thing in the universe that would have brought me back did. So that's, kind of the story of how we ended up here. And then Tacoma, Washington, I think is another real gem, that's not well known, but there's the largest transition story, I think, happening in the entire United States. It's happening in Tacoma right now. Most of our assets there cluster around a place called Point Ruston. So that's a fun Google. It was the largest copper smelting facility in the world for half a century. And then when all of our industrial jobs went overseas, it turned into an EPA Superfund cleanup site, literally like a toxic waste site. And so when you think Tacoma, you think kind of industrial and gritty. Well, that's kind of a dated perception, because today Point Ruston, it's all cleaned up and it's now a multi-billion-dollar master plan community. It has an ocean-going vessel as one of its amenities. 100 acres, 1 mile ocean front. So you have to imagine going from like toxic waste site to the nicest piece of real estate I've seen in my entire life. And then imagine the knock-on effects that has on everything around it. So, tens of thousands of workforce housing units were built in the mid-century, 60s and 70s as the workforce for Point Ruston. And then that all kind of went downhill, when those jobs disappeared. And now that's all roaring back with information workers that are, commuting to Seattle to work at Amazon and Microsoft. So, one of our projects there, a block to the south is, what seems like ought to be a knockdown. And then a block to the north is literally a brand new Trader Joe's and Whole Foods across the street from one another. And when we bought it, our in-place rents, I think, were like $800 a month. And our rents today, 18 months later, getting close to 2 years later, are $2,000 a month. There's not a lot of places where you can double the rental rate. And Tacoma is one of them.
Nice. Well, I'm all for market expertise and not doing the shotgun approach. Really understanding your market, which you obviously do, and it just gives you a huge advantage over others that just pop in occasionally and try to buy, or they got stuff all over the place. It's like how often do you see your property? How well do you know what's going on? It really gives you a big advantage.
My wife and I got engaged on top of Mount Rainier, which is in Tacoma. So it's a place that certainly has a special, just special place in our heart.
Nice. Well, I appreciate you coming on, Nick, and sharing your expertise on infinite returns and being vertically integrated. Where can listeners find out more about you and your company?
Yeah, anyone here can go to meetblackswan.com. There's a link to my calendar. You're welcome to, block 15 minutes on my calendar to chat. If there's anything I can do to provide you with value, you can, sign up for our mailing list. We do tons of free education events. We've got our conference coming up this fall, which is unlike any conference you've ever been to. We get on a bus and tour our, kind of messy middle renovation apartment buildings. So you get to see like a before renovation unit and an after renovation unit. And it's hosted at the #1 rated Hilton in North America. It's a pretty cool conference. So you can check all that out at meetblackswan.com.
All right. Awesome. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.